If you're still losing money trading order blocks, it's probably because you've been taught the wrong way. Today, we're breaking down what order blocks really mean. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you. Order block is the price zone that the price likes to move back to this zone. For example, in this graph, the price rises first, then rises again. Every time it rises and goes up, if the price goes up, we will call it a breakoff structure. This is the point where we can find the order block, and the price has the opportunity to come back to hit the order block and go up. After a while, the price goes up again, and a breakoff structure occurs again. Therefore, you will get a new order block, and this order block will do its job as a price zone. Wait until the price comes back to the zone. When it hits, the price will have a chance to rise again. You can see that the order block is an important zone. Therefore, today I will take you to hunt for the best order block. If we find an order block, these order blocks have a lot of opportunities to make a lot of profit. For those of you who have just opened YouTube and come to this channel, you still don't know what order block is. So, let's learn about order blocks together today. The first one is called engulfing order block. The second one is hesitate order block. It is a block of hesitation. The third one is impulse order block. The price of this order block will rise to be a large green bar. Many bars are attached. And the last one is pause order block. It's an order block that prices rise, there's a little bit of hesitation, and then it goes up. This time, not every order block will be able to be used effectively. Today, I have 4 gains for you to check. What are the 4 gains? Let's take a look. The first gain is that a good order block should have a breakoff structure. When a large group collects goods within the order block, it will raise the price to the same high. At this point, a breakoff structure will occur. The second gain is that a good order block should have a gap or a fair value gap. The third gain is that an order block should be unmitigated. That is, this order block should no longer be used. If the order block is used, it will be considered that it is not profitable. And finally, a good order block should have a liquidity sweep around the order block. I will take you to look at each gain, and in the end, I will include all 4 gains together, and let's check to see which order block has 4 gains or not 4 gains. The first gain is breakoff structure. The example is as follows. The price came up first. There will be an uptrend and continue to rise. The area where it continues to rise, it will cause a breakoff structure. When the breakoff structure occurs, there will be an imbalance. If we go back, we will get an order block. This order block is considered to pass the gain because it is an order block that causes a breakoff structure. In a while, the price will go back and continue to rise. The price will go up again, causing a breakoff structure again. In this area, it is set to be a trend imbalance. Looking back, you will see a period when the price is hesitating. In this area, it is set to be a post-order block and an order block that passes the gain because it causes a breakoff structure. Finally, there is a breakoff structure that occurs again. This order block will be an order block that passes the gain. A trend imbalance occurs, an order block occurs, and the price goes up. The next example will be the market falling. The price came down first, there was a drop, and then it went down. When it went down, it made a new low. There was a breakoff structure, there was a tankade imbalance. If we go back, we will get an order block. This order block goes through the first gain because it is the initial order block that causes a breakoff structure. In a while, the price will go up and go down again. There will be a breakoff structure again. This large red bar is called an imbalance bar. There is an order block in this area. This order block also passes the gain because it causes a breakoff structure at the bottom. Next, the second gain is the gap and the fair value gap. There are examples to see both the usable and the unusable. On the left-hand side, you will see an order block. When the order block occurs, there is an imbalance. This area is a fair value gap or a price gap. The price has dropped and risen sharply. Therefore, the price has a chance to move back to the price that is done. We call this point a fair value gap. Therefore, this order block, it is considered to be an effective order block. On the other hand, on the right-hand side, we will also get an order block because there is an imbalance. But if you look at it, the price is not very high. The price has risen, but it has already returned. Therefore, our gap will be very narrow. When it is too narrow, we will consider that this order block is not effective. Let's take a look at the real example. The first example is on the left-hand side. The price goes up and there is a break-off structure. We will get an order block coming up from the bottom. The next step after the order block, we will get a fair value gap. Therefore, this order block through the gain is effective. After a while, the price goes up and goes up again. When it goes up, we haven't done anything yet. Wait for a while, the price will break off structure again. We look back, we will get a post-order block. This order block also creates a fair value gap. When the price rises sharply, it becomes an empty space of the price. We consider that the previous order block was effective. But if we look back on the left-hand side, this area is also a post-order block. The price has risen dramatically, but we don't see a fair value gap. Or the fair value gap is too small. We will set it to be an unprofitable order block. Why? Because the price is just a moment. Woke back and broke the order block. When there is no fair value gap, the price has a chance to break the order block. Go find a better order block. Another example, it's still a market. The price has risen and continued to rise. At this point, a break-off structure occurs. We got an order block. In this area, there is a large space of price. There is a fair value gap. Therefore, this order block passed the second gain. Not long ago, the price rose back and continued to rise. In this area, a break-off structure occurred. If we look back, there will be two large order blocks. One on the top is a post-order block, and the other one on the bottom is a normal order block. This order block is set to be an effective order block because when an order block occurs, the price will rise and create a gap. Therefore, this one is considered to pass the gain. The one on the top, if it looks good, it will pass the gain as well. But I didn't draw it up for you to see. You can try drawing it and check it out. You will see the fair value gap and consider this order block through the same gain. The third gain is called unmitigated. A good order block must not be used. For example, the graph on the left-hand side. The price is rising and rising. We got an order block. After that, there is a space of price. Notice that the price did not return. When the price doesn't go back, it won't hit the order block. That means that this order block is not yet in use. Can be used in the future. But on the right-hand side, when we get the order block, notice that the price is moving. But in the next bar, the price has gone back. When the price hits this order block, we will consider that this order block have been used or mitigated. Therefore, in the future, this order block will not be effective. The price will have a chance to come back and continue to fall. Let's look at the real example. This example is a market that has risen before. There was a growth and then it went up. When it went up, there was a break-off structure, a trend imbalance, and then an order block came up. But if you look closely, there will be a bar that drops down. When it drops down to the order block, we will consider that this order block has been mitigated or used. When it is used, when the price goes up and goes back, there is a chance that the price will not be interested in this order block. For example, around here, the price acts like it will go up, but it can't go up far. It will go down again. If it goes up again, it won't go up again. In the end, this order block can't be accepted anymore. The price went down the order block and went down for a long time. The price went down the order block and went down for a long time. Another example is that the market has risen. There was a new break-off structure. When the first break-off structure was created, we got an order block. This order block creates a fair value gap, and notice that the price did not work back at this order block. Therefore, this order block is unmitigated. The price has a chance to come back in the near future and go up. Another point, we also get an order block after it breaks off structure. This order block is not yet used. Tengtian has already gone. It hasn't moved back yet. We consider it to be unmitigated and can continue to use. The last gain is Liquidity Sweep. A good order block should sweep the liquidity of Tengtian in advance. For example, on the left-hand side, we have an order block, which is around here. This order block is long. That means Tengtian in advance. If there is liquidity, it will be washed away already. I would like to specify two bars to compare. The first bar is considered to be the first bar. The second bar is the order block. The lowest low point of the first bar is around here. Investors who buy at the end of the first bar will set a stop loss at the bottom. But when the second bar occurs, the price is less than all the liquidity of the first bar. This kind of thing, we call it a liquidity sweep, set to be an order block that is effective. But on the right-hand side, it will be an order block that cannot be used. The order block will be in this bar. There is the first bar and the second bar as before. The first bar has a very long range. That means there is a lot of purchasing power, and there will be liquidity left at the end of the first bar. When we draw the order block at the second bar, when the price goes back, what happens? The price has not yet been sweep liquidity. The price will continue to go down, continue to sweep all the liquidity of the first bar. That means that if we use the second bar to build an order block, our stop loss will be under the order block and have a chance to be pushed down by a big line to collect liquidity of the first gold bar. Therefore, in this situation, it is considered that our order block is not profitable. Let's take a look at the real example. This example is still a falling market. There is a rise and then a rise for a period of time. On the left-hand side, there is an order block. If you look at the gold bar before, you will see that the low point is around here. Our TNT order block has exceeded all liquidity. Therefore, we can continue to use it through the gain. After a while, the price rises, hits the order block, and continues to rise. When the price rises again, there is a break-off structure again. We can build a new order block. But this order block is not very safe, because the previous 2 to 3 TNT blocks had quite a long size. And this block has a long chain that is not enough to sweep the liquidity of the previous block. Therefore, this chain will be very risky in building an order block. The price has a chance to go back through the order block to the rest of the liquidity before it goes up. Therefore, the stop loss that occurs from this order block will be considered very risky. Another example is the rising market, but there is a deep increase. When it increases a lot, there is an order block. This order block is considered not to pass the gain. Due to the previous trend, there is a longer interval, still not able to liquidity sweep. We can't use this order block. For a while, the example is in this area. This area is another order block. Due to the price, there is an imbalance trend and a break-off structure, but this order block is expected to be profitable. Because of the previous 2 to 3 tiers, it's all more than liquidity. The lowest tier is around here. It's already been liquidated, considered to pass the gain. Okay, to this point, you all know the 4 gains of the order block that are profitable. I'll take you to look at 3 to 4 examples, and let's see how many gains each order block has. If you pass all of them, it's considered to be very profitable. If you pass some, like 3 or 2, you have to decide whether to use that order block or not. Let's take a look. The first example is a rising market. In this area, there's a big imbalance. There's a break-off structure. If we look back, we will get an order block. This order block goes through many gains. There is also a fair value gap. Moreover, the price is not returned. Therefore, we will have a break-off structure, a fair value gap, and the order block is not yet used. After 3 gains, let's check the last gain, which is around this low point. You will see that the chain that created the order block has exceeded all liquidity. Therefore, this chain will go through the gain liquidity sweep. In conclusion, this order block is very effective through all 4 games. Next, when the price rises, there is an increase and a new rise. At this point, there is a break-off structure. Looking back, we will get an order block. But if we look closely, this order block will not have a fair value gap. And most importantly, the price has returned to the order block. Now we only have a break-off structure. But we don't have a fair value gap and we're already used to it. Finally, if we check liquidity, this area is a low point. Our order block tag has been priced down. Therefore, the liquidity sweep has been done. It turns out that this order block has 2 gains and 2 losses. For me, I can't use it. The next example is still a market that has risen. The price rose before there was a rise and then rose again. The point where it rose again was the break-off structure. If you look back, you will find that there is an order block. But this order block looks bad. Looking around, there is no fair value gap, and the price has returned to the order block. Therefore, what we have is just a breakoff structure. There is no fair value gap. It has been used for a long time. Therefore, it is not very effective. The last check gain is looking back at the low point. Before, the low point was around here. Now, it has gone down to liquidity. Therefore, this order block will pass the fourth gain. But because it passes only 2 out of 4, I will let it not pass the gain itself. After a while, the price goes up and rises again. After the rise, it goes back up and there is a break-off structure. If we look back, we will get this bar as an order block bar. At this point, if you check it, there is a break-off structure. There is a fair value gap. The price did not go back to the order block. Therefore, after the gain, there are 3 points. The fourth point is very easy to see. The low point is around here. Therefore, the longer the liquidity, it is considered that the other gain becomes a complete order block. The price has a chance to roll back, hit the order block, and bounce up. The third example is the last example of the rise of the price. The price rose and continued to break off structure. Looking back, we will get an order block. We check the fair value gap first. After that, we check mitigation. The price did not mitigate this order block at all. Therefore, it went through 3 gains. But if we check the last gain, we will find that the previous candle has a very long candle. Therefore, this candle that created an order block, there's still a little bit of liquidity left. We will consider that it is not yet past the gain. It is not yet past the gain. And what to do? Is there a way to fix it? Yes, it's very easy. We move to 1 bar. For example, our order block is at this green bar. Now, if we move back 1 bar and we build this bar to become an order block, at this point, if we check again, we will see that there is a gap in the fair value, and this order block is not yet mitigated. Therefore, now we have 3 gains. The fourth gain, because we have moved, the lowest low point is around here. The current trend is higher than liquidity until it runs out of max. Therefore, now we will consider that this order block has sweep liquidity and passed the gain. This method can be used as an example. In the past, it did not pass the gain. Try to move to the left or right to see it may pass the gain. And the order block that occurs from this move becomes an order block that is positive instead. The last example will be the fall. The price goes down first, there is an increase, and then it goes down. The point that it goes down, there will be a break-off structure. If we look back, we will get an order block. This order block creates a fair value gap at the bottom, and there is no price to touch back. Therefore, through all 3 gains, the last gain. If we look at the high price, we will see that this price that creates an order block is better than all liquidity. Therefore, we consider it to be through the gain. Liquidity is sweep through the gain. It is considered to be an effective order block. On the other hand, if you look a little further, when the price goes down, there is a drop and a new drop. At this point, the price breaks off structure in the trend. The price falls to the low point. In this area, if we look back, we will create an order block. But this order block is not profitable. Through the gain break-off structure is true, but the fair value gap is small. It is not through the gain. And if you look at it, even though it will not be used, but it has a disadvantage because it has a long chain. This chain will have liquidity waiting on the top. This order block is not better than all liquidity. Therefore, it will not pass in the last gain. The way to fix it is not difficult. The first one, we don't care about this order block. Or friends choose to draw a new order block. The way to look back around here, if we look at the whole zone, it looks like a base or a base. At first, the price had a rally. I found a big base. After that, there was a drop. In the base area, we can draw a new order block to make it wider than before. For this order block, you can check the gain per gain. First, there is a break-off structure. Second, there is a fair value gap. Third, the price did not go back at all. In this zone, the price has gone and accepted. And finally, in the previous area, there is no liquidity left. Between this one and this one, more than liquidity. Therefore, this order block can be used through all 4 gains in the future. The price has a chance to bounce back, hit this order block, and bounce back. All of these are the 4 gains that you can use to check the order block. The most effective or the best order block should have all 4 gains. If it's done, you can buy it or wait for it. When the price goes back, there is a chance to bounce and go on. See you in the next clip with other smart money concepts. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you.